Recently in the video, I encourage people to go out and start investing in the stock market because of the potential of long-term gains as well as compound interest. However, I do want to note for everyone that there are times that you might actually lose money in the stock market. So in this video, I'm highlighting 6 popular ways that you can lose money in the stock market. The first way that you can lose money in the stock market is because you're paying commission fees. So sometimes when you're trading or when you sell a stock or buy into a stock, a company or the platform that is facilitating that trade, they will charge you maybe $3 to $8 depending on the trade. However, there's apps that can help you mitigate that issue where you don't have to pay for stock trades, such as Robinhood, Charles Schwab, and Fidelity. So if you're doing a lot of trades, you could actually lose a lot of money in the stock market because commission fees are taking a big bite out of your possible gains. Another way you lose money in the stock market is via fees. So most retirement funds, exchange traded funds, mutual funds, and index funds, they charge you fees. However, mutual funds tend to charge you the most in fees. It's necessary to review your retirement accounts to see how much they are charging you via fees and if it makes sense for you to switch over to an individual retirement account. You can also lose money in the stock market when you invest in a company that declares bankruptcy in the future. That means your shares are now dwindled down to zero. They don't have any worth. And the only recourse is to hope money is left over after the banks liquidate their assets. That way they could pay their shareholders some money. Probably the most common way people lose money in the stock market is if you sell the stock at a lower price than what you bought it for. If you buy a stock at a certain price and it goes up, then you sell, that means you actually have realized gains and you have earned income from selling that stock. So you don't actually earn or lose money until you sell it. So depending on where you bought it at, that makes a difference in you gaining money in the stock market and losing money in the stock market or staying the same. Number 5, you sell your stocks when the stock market is on a steep decline. For example, when the stock market crashes. So in years 1929, 1987, 2000, 2001, 2002, 2008, 2009. So these are different years that stock market actually drastically declined, and a lot of people sold their stocks because they were worried about the situation. It actually goes back to the previous issue, which is people are selling when stocks are low, when they already bought high. When the stock market is crashing, it's natural for a lot of us to get emotional, and it's real difficult to actually stay 10 toes down in the stock market when everybody else is getting out and moving their money elsewhere. So it's an especially critical time when the stock market is crashing, when you're nearing retirement age, because it's a possibility that you could lose a lot of your account funds during this time. One of the best things that you could do if you're nearing retirement age is to move to a more conservative retirement account. That way your money is invested more so in bonds, where it's safer and more secure, versus stocks. You can also lose a lot of money in the stock market via taxes, because when you pull out and you actually achieve gains in the stock market, that money is taxed like it's regular income. So essentially, you will be paying the government at least 30% of the interest that you accrued in the stock market. This is one of the reasons I'm not a big fan of day trading, because if you add the taxes, the commission, and the fees that you have to pay in the stock market by moving money in and out of accounts each day or each week, you're going to end up with a lot of losses just by doing transactions. Now that I share with you those different caveats to making money in the stock market, I do want to reiterate that over time, the stock market is beneficial and advantageous to participate in, just because since 1926, the creation of the stock market through today, the stock market has gained 10% average yield year over year. So if you're in the stock market and invested in index funds or ETFs that closely track the stock market, you're usually safe if you could stay in the market through crashes and through stock prices going down, versus investing in individual stocks, because those are a little riskier. However, if you are investing in individual stocks, there's a good chance that you can make a lot of returns, especially with big companies like Nike, Facebook, or Google. For example, Chipotle earned 93% last year, and Target earned 95% last year. So those companies, if you invested $100 in those companies, your stocks are worth $200 now. But with those being individual stocks, there's always a chance that your stocks could become worthless. Thank you for paying attention to this video. Let's share our lessons learned. I want to spread the knowledge about stocks, spread the knowledge about financial literacy, and let's talk about it. Let's have a conversation. Drop a comment, share your experiences with the stock market, or what makes you nervous about the stock market, or something that you might want other people to touch on. Let's have a conversation. Get your money up.